warm welcome to all of you. In today's video, I'm going to talk about investing in mutual funds. It is everybody's dream to own a car, a house, or a simple wealth creation. So let's see how mutual funds helps in achieving these dreams. Taking a leaf out of my previous video, where I touched upon various asset classes, today I will talk about mutual funds. I will try to provide a brief on what a mutual fund is and to whom it is suited, and what are the various types of mutual funds available in the industry, and how big is the industry itself. And let's see briefly what are the various ways to invest in a mutual funds that is available today. So what is a mutual fund? A mutual fund is a professionally managed trust that pools the savings of multiple investors and invests them in securities like stock, bond, money market instruments, global assets, commodities, or derivative instruments. This fund will have a specific investment objective, and the investor, whoever invests in that particular fund, will have a common investment objective. That is, if an investor wants to buy a large cap stock, he will buy a large cap mutual fund. So the large cap mutual fund manager will invest in large cap specific stocks. Similarly, so one can invest in parts or in lump sum. So when I say in parts, if your portion of your salary can go towards on a monthly contribution through systematic investment plan. Or if you want to do a wealth creation, you can do a lump sum investment. It is ideal for retail investors who is looking to create wealth over a period of time. Also, it is ideal for an investor who has no prior investment knowledge. So definitely mutual funds will help them in achieving their investment goals. So moving on, who can invest and what are the benefits of investing in a mutual fund? Broadly, any resident Indian with a valid KYC can invest. Selected non-resident individuals and foreign nationals as permitted by SEBI, that is Securities Exchange Board of India, and non-individuals like corporates, trusts, institutions, etc. can participate in mutual funds. The benefits are professional management. There is a fund manager appointed to manage a particular fund. So it is his duty to take care of your investments on a day in and day out. Diversification. Mutual funds provides a very good diversification for your investments, which has typically a spread of around 40 to 50 stocks in its portfolio, which otherwise you would not have done with a small amount. It also provides ample liquidity facility, wherein depending upon the fund that you have selected, your funds can be redeemed over a period of 0 days to a maximum of 3 working days. You will get back the money. It is completely transparent, meaning you will come to know the value of the fund every day through a daily newspaper. Also, you will get a monthly fact sheets on a monthly basis explaining the holding. It is well regulated by SEBI. It gives you a greater flexibility in choosing the type of fund that you want to invest depending upon the risk profile. That is, be it a liquid fund or a equity fund or a debt or a mix of all. So now moving on, we can broadly classify the mutual funds into the following categories. That is money market fund. Then you have the fixed income funds. Then you have the balance fund. Then followed by equity funds and the sectoral funds. So if you look at the matrix, the risk in the x-axis and return in the y-axis, the low risk product would be your money market fund, where similarly it also delivers a low return, whereas the high risk product would be a sectoral fund and it delivers equivalently higher return. The return is directly proportional to the risk that you take. Basis the inherent risks and rewards it offers, these funds are recommended exclusively or in combination to investors based on the risk profile they belong to. So normally we classify investors into three broad categories. First being a conservative one. These investors are the one who chooses not to take risk on his or her capital and seeks a fixed deposit plus kind of a return. So for them, money market funds and a fixed income fund would be ideal place to park their money. Moderate investor is one who is ready to take marginal risk by taking calculated exposure to equity through a mix of balanced funds and equity fund. While an aggressive investor can take risk by investing in equity or a sectoral fund in search of capital growth and wealth creation. Since 2014, the mutual fund industry has witnessed a sharp increase in the number of folios which now stands at a whopping 6.2 crore. Assuming an average investor holds 3 to 4 folios, we are talking about a unique accounts of around 1.5 to 2 crores. That means if you take the India's population of around 150 crores, we are talking about just 1 to 2% of India's population that has participated in this industry, leaving enough scope for future growth. The mutual fund industry by itself has grown from 16.86 trillion in October 16 to roughly around 22.73 trillion in November 17. This represents a whopping 30% growth in assets over the said period. As of October 17, the aggregate deposits with all scheduled banks in India, as reported by Reserve Bank of India, stood at 111.43 trillion. Interestingly, the mutual fund AUM as a percentage of bank deposits is only 20% in India as compared to 150% in US. This leaves us a huge scope for the industry to grow in future. So if you look at the composition of folios, individual investors account for most of the mutual fund accounts across funds, but it is institutional investors who has contributed the largest average investment ticket size. So that means an institution invests on an average around 12 crores, whereas an individual invests only an average of 80,000 per folio. Further drilling down, what we get is as of 2017, mutual funds collectively manage around 49% of the assets of individuals, which has increased by 4% as compared to a year before. There was a sharp increase in equity accounts in 2016-17, while debt schemes showed a declining growth rate. This clearly projects the shift in investors' preference towards equity funds. All thanks to the investor awareness created by AMFI through various media to provide financial savings habit among Indians. The result is the industry has witnessed a massive 1.8 crore SIP account and money through SIP stood at nearly 6,000 crores in the month of November. More than 80% of institutions' money is parked in fixed income oriented products, while it is contrasting mix for individuals where more than 60% of the money is invested in equity oriented schemes. The message is clear that individuals come in for long term wealth creation. Not only that, 34% of the money invested in equities have stayed for more than 24 months. That is a real big time. There are various ways to participate in mutual funds, the most preferred route being a traditional mode wherein you fill in application and submit to the collection centers spread across the nation. Of late, the industry has also witnessed many technological innovations and new entrants to help it to smoothen the entire process and aid financial inclusion, thereby reaching investors even in the remotest place in India. So there are platforms available, online platforms available like Zerodha, ICICI Direct, Prudent, or MF Utilities, wherein you can log in and start investing through them. Or there are a bunch of apps available today wherein you can invest in direct as well as regular plans, or you can take the help of an online advisor or do it yourself kind of an approach. But remember, do it yourself kind of an approach is strictly recommended for those who have prior experience in investing in this space. Otherwise, it is always better to approach your advisors or distributors to know the right product and asset mix based on your risk profile. You can reach me through the comment section below for any further queries. And if you like the video, give a thumbs up and hit the subscribe button. Take care and happy investing until I see you next time with one more interesting video. Thank you.